Well, welcome everybody to the Thursday, May 23rd mentorship webinar. Just want to remind you that tonight at 4:30 Eastern Time, I'm going to be giving a presentation on Trade Monster on the exit strategy using the Fibonacci's, and I've got plenty of examples of how the fibs just pinpoint the exit. Sometimes within the tick, it's very uncanny. So I invite you all to come into that webinar. It's free. You just go on to mytrademonster.com and scroll down and register for the webinar, and I will be there. And this evening's blog will be a little late because I've got I've got to check all my audio and stuff like that. So I'm going to be doing that. So the blog will come after that. Okay, let's take a peek at what's going on. Let's take a look at the Dow here, and let me blow that up a little bit. What happened yesterday? Well, what happened yesterday is the market opened very strong, and then Big Ben was on Capitol Hill talking to Congress, basically saying the Fed policy is going to remain the same, and then the FOMC minutes came out, and people reacted bearish to not only what Ben was saying, but what the minutes were saying. And we go back to May 1 when the FOMC finished their two-day meeting, and they came out with the summary about 2 o'clock in the afternoon. You can see how the market reacted to that. It was kind of like, oh, you mean you're not going to come in and save us? And then the market just continued on. Well, is that what's going on now? I mean, yesterday was a huge drop, and now the market's going, yeah, okay, and maybe we're going to continue on. I don't think this is the pullback. I really don't. It continues to be strong. The way the market has reacted today just, makes me look back at the way what it did back here, and yesterday we lost a little bit on our bullish bull call. That's good. Our bull put, but that's okay. It's coming back today, and that's fine. Just about every indicator showed the same thing. Every indicator was weak yesterday. The S&P 500 is continuing to be a little bit weak today. The Nasdaq actually started out way down here and has come roaring back. So you're getting a little bit of mixed messages here, and the RUT did the same thing. It opened way down, and it's coming back. So I think, what we do is just carry on with what we're doing. Absolutely. I don't see this as a change in market direction at all. Thought maybe it was going to be the beginning of something, but went back to the market reaction to Bernanke's talk in May 1, and it's the exact same thing. So status quo, carry on. Okay, so we're going to continue on with our bull put spread on the RUT. And we also have the same thing on Apple, and you can see that Apple is even though the market is a little bit weak today, Apple continues to be strong. We have a bull put on Apple, and if we just take a look at the Analyze tab for the RUT, you can see we're fine there. Let me bring this down to here. Okay, and the same thing's true on AAPL. Okay, so we got the minus 600 way down here. So both of these look good. We'll just continue on holding these because I think the market is going to, continue to move on up. And, I was talking to Fred on the phone the other day, and Fred said, well, can you just spend a little bit more time today talking about, the difference between the bull put spread or the vertical and a regular call. And I said, absolutely. So I prepared a little something here, and let's go over this. This was a chart of PepsiCo, and if you remember, PepsiCo came down and then it came up and made a bottom here and then started its long rise to the top. So I just took the period from here to here to just look at the comparison between a call and a bull put spread. They are both bullish strategies, as indicated by the name bull put spread. The difference is with a call, you are buying an instrument and you buy it at a certain price, and if it is bullish, that price will increase. So if you bought it at $3 and you sell it at $7, you've got an increase of $7. The bull put spread is a theta trade. All theta trades are just the opposite of buying a straight option, because what you're doing is we are selling. And usually we are selling deep out of the money. Okay? Whereas when you buy a call, you're buying deep in the money, if you will. We're looking to get about 10% of the underlying price and take it off of there, and so then we're going to go ahead and get a deep in the money call. And that's usually going to be around a delta of 0.8. So for every dollar the stock moves, the option moves about 80 cents. Okay, so that's the difference. We're buying deep in the money. We're selling deep out of the money, and they're just the opposite of one another. They're both strategies thinking that the market is going to go up. But one, you're buying, so that's positive, and the other, you're selling, so that's negative. Okay, so what I did is I just went through here and I picked out this day right here and said, okay, let me go ahead and buy a call here, and let me go ahead and sell a bull put spread here. And then I'm going to look at it again when it's up here. Then I'm going to look at it again when it's down here. Then I'm going to look at it again when it's up here. Okay? Goes up a little bit, then comes down, then goes back up. Okay? So we're going to see the relationship between the two. And, I'm not advocating one or the other. We usually buy straight calls, but bull put spread, and there's a lot of people that do verticals, and they absolutely love them. They're a little bit, with a vertical spread, you have limited reward for a little bit more risk. Versus a call has unlimited reward for limited risk. Okay, so, but but you can structure a bull put spread so that it's a pretty nice structure. You can maybe structure it so that you almost have for every dollar increase you have in reward, you can limit it to about $2 loss, and that's pretty cool. It's pretty cool. So let's go through a couple of these and see if they make sense. When we started out on October 24th, and this was last year, that was right here. If I bought a call outright, it would have been the December 62.5. If you can see here, it was right around 68.5. So we were deep in the money, and we bought that for, let's say, $6.05 or $605. Now the second strategy is the bull put spread. So here I want to sell. And I am selling a deep out of the money 67.5 put, and then one further out at 65. I'm buying this one back for protection. Okay, so I'm selling this, I'm buying this, I'm selling this. So at that point in time, the premium on this put was $1.25. Well, I'm buying this one back, and that was 54 cents. So my net credit is 70 cents, but I don't get that net credit. That's what it would be if PepsiCo is above 67.5 on expiration, and the expiration on that was for, I believe it was for, probably I looked out to December on this one. Okay, so that 70 cents credit, 70 times 100 is $70, and let's say we bought 5 contracts. Well, we've got a $2.50 spread between the two here. So $2.50 times 100 is 250 times 5. So we're going to need a $1,250 margin. Okay. Here what I need to put up is $605. Here what I need to put up is $1,250. It's okay. It's okay. The credit that I can get if this goes all the way to expiration and is above the 67.5 is the $70 times 5 contracts, or $350. Okay. This is the max I can get. I can't get any more. I can't get any more. And this only goes into my bank account when it expires, and I usually don't like to let things expire. Okay, so again, when you set this up, when you buy a call or a put outright, you are buying for a certain price, and that's it. That's how much you have to put up. It's the max you can lose. When you do a bull put spread, it is a bullish strategy, but this you're selling. So you are selling this, you're getting this premium, you're buying this back for protection. This is the credit that you can get times 5 contracts. This is the max credit that you can get if by the December expiration it's above 67.5. Okay. Okay, now remember, we're recording this, so you can always go back at any time and listen to this again if it's too much for you right now. The other thing is I will be sending everybody a PDF of this, so you're going to be able to have this in front of you, listen to what I'm saying again, make your notes until it becomes clear. Buying, both bullish strategies, buying, selling. Okay, this is just, you have to think in terms of just the opposite here, because I'm selling something, so So what I want to do is see this 70 cents credit go to zero. If I do, I'm going to get $350. But if it doesn't go to zero, I'm going to get the difference between what it was when I sold it versus what it is when I buy it back at some point in time. Let's say it goes down to 20 cents credit. I will get the difference between 70 cents and 20 cents, or 50 cents credit times the 5 contracts. Okay? Okay, we go into this day here, which was November 1st. We had a little bit of rise here, so you should expect both of these strategies to be making money. And you can see that the December 62.5 call went to $7. We bought it for $6.05. It's now $7. We made $95, or 16%. On the vertical, we let's see, where did I get 74? Whoops. That should be, I believe, 70. Whoops. Yeah, this, okay. Okay, what this is that is now the price of the 67.5 that we sold. So we're buying this back. So the 70 cents credit now has gone to 44 cents credit. Okay? And that's good. That's good because we sold here. We sold here. If we were to get this, we would have to buy it back, and the difference would be we sold and now we bought back, so we made 26 cents, or $26 per contract times 5 is $130, or 1%. Okay, because we've got more margin here than we have here. But that's okay. That's okay. This is a less risky strategy, but you're not going to make as much. But what's cool about that is now we look at the little pullback here, and you would expect that, well, now my straight call might be in a little bit of trouble, whereas the bull put spread might still be okay. And sure enough, it is. The December 62.5 call is now only worth $5.70. So I am down $35, or down 6%. Whereas the vertical spread, now the 67.5 put is now worth $1.04. The 65 put is worth 36. So I've got 68 cents credit. I originally started with 70 cents credit, 2 cents to the good, 5 contracts, made $10. So I'm just about even, versus a straight buy where I would be down quite a bit. And now we hold all the way over to here, where you would expect both of these to be making money, and they surely are, because the December 62.5 call is now worth 7.88. We bought it for $6.05. We made $183, or 30%. The vertical, the 67.5 is worth 17 cents. The 65 put is worth 6 cents. So now it's worth 11 cents credit. That's pretty cool, because we sold it for 70 cents. Now we can buy it back for 11 cents for a net 59 cents, and that now goes into our bank account. So we've made just about as much as we would have with the straight call, but we avoided some heartburn as it was going in the opposite direction. And that's the nice thing about the bull put spread, because you can make money on a bull put spread. It's a bullish strategy. If the market goes up, or if the stock goes up, you make money. If it goes sideways, you make money. If it goes down a slight bit, you make money. You don't make quite as much, okay? You're kind of capped. You're capped. This is the max you can make. That's the con, Okay, the pros are you can make money if it goes up, sideways, or down. Now, on a straight call, you only make money when it goes up. If it goes sideways, that premium is going to decay. If it goes down, you've got not only premium decay, but you've got the intrinsic value going down. Which one of these you choose to use is totally up to you. I've got a lot of people that use both. They use the bull put spread. I've got a lot of people that use just straight calls. It's totally up to you. They're just the opposite of one another. They're the negative of one another. Okay? Because theta, you make money when the theta decays, and that's what happened when you sold this for 70 cents and bought it back for 11 cents. You've made this 59 cents of theta decay. Okay, let's see if Fred is here today. Fred, is this totally confusing or
no? It's very plain. And what I will do is take this, and I will separate those two, and have a sheet showing the call, and then another sheet showing the bull put, so that I can do that. I mean, that's the way I am now. And the next question, of course, is the bear call exactly the opposite, or do you have a sheet for that too?
If Fred, if you took this and at the top you put bearish strategies, you'd have one would be a put, or two would be a bear call spread.
Yeah.
That's exactly right. That's exactly right.
You still buy and you still sell the same way.
That's exactly right. Yes.
Okay.
All right.
So you'd buy the put, and you'd sell the bear call.
That's exactly right. You're selling the one option, but you're buying the one deeper out of the money for protection only.
I see.
Okay.
All right. Thank you.
All right. The other thing, Fred, that you could do is just say, let me not confuse you. What I would suggest you do, and I will send this out, is just take a look at the chart and listen to my description again, and have this in front of you. And like you said, you might want to separate it out and go over it, because this is an important concept, and I'm glad you brought this up, because I want to make sure everybody is got that concept. So thank you. Okay. Let us go ahead. Let me make sure there's no hands are up, and I do see some hands up. So James Belt, see your hand up. James, question.
Yes. My question is do we use basically the iron condor when the market is flat, or we use both the two different verticals? And if we think the market's going one way, we use one vertical. If it's going another way, we use the other.
Yeah, let me mute you, James, because we had some feedback there. That's exactly right, and that's why right now we have on, the market is definitely strong. So right now, the best thing for us to do is put on the bull put. Okay, so we're using the vertical spread that's bullish. Okay, the bull put. If the market was going down, like during this period here, it would be prudent to use a bear call. However, my first choice is to look at the iron condor that has both. And that's the kind of strategy that's good during periods like this where it's kind of flat. But this period where you've got a lot of strength, and you have had a lot of strength for a while, I think it makes sense to do the vertical spread in the one direction only. It's a good question. Good question. Jim, I see you have your hand up. Let me unmute you for a second. Jim, can you? I know you can hear me.
Dale, I was impressed with your display there. That was very nice. I'm wondering if you would be willing to put together a chart using the bear call and the put.
Yeah, I can do that, Jim. Of just a matter of time, but I will try to do that, and I'll try to pick a section at random. I might even use PepsiCo. Let's just take a look at PepsiCo. This would be a good section to use. Let me see where I was. Let me go back here a little bit. We made money on a put on PepsiCo here, and then got kind of shaked and baked here, and made money on a call. This was the section that I was talking about today, where it went up and down and up. Might be good to look at a bear call, buying a put here and selling a bear call, because then it goes down, then it comes back up, then it goes down. So that's exactly what I'll do, Jim. That's exactly what I'll do. Okay?
That was a wonderful illustration.
Well, thank you. And what I'd like to do is make sure that everybody has that in front of them when they go over it again, because it's something that you can easily get confused on, and I don't want you to be confused, because it's selling theta is just an important concept, and we definitely want to have everybody on board there. Okay, super. Let us go ahead into our weeklies. And why don't we go right in and talk about the FOMC minutes. We talked about everybody putting this on. Usually on an event like this, I look to put this on about 10 o'clock in the morning of the event. And if you did that, you would have put it on, let's see, this is right around in here. Right around in here. So you would have made a boatload of money in one day. Okay? I saw a squeeze that happened within the last hour, and I bought a strangle right here, thinking that maybe it would be flat till about 2 o'clock, but that's not what happened. It actually, early morning, had a big rise. And what I did is I went back to here, which was the low right here, okay, and looked at what this latest move was. Put on a Fibonacci from here to the high, to the higher low, and I saw that the 161.8 was right here. Okay, 161.8 is right there. Let me blow this up a little bit. So I'm sitting there with the strangle, and the market opens, and I already have an order in that if FAS gets to 72.73, I'm out. And sure enough, it did. It got there, by about 10:15. And it was going so fast through there that by the time I got out, it was actually up around here. And I looked at that, and I'm still watching the market. It's about 10:15, and I heard ding, and I said, well, what the heck is that? Well, I wasn't watching this, but I checked my messages up here, and sure enough, I had sold the call portion of the FAS. And I thought, well, this appears to be going up. I wonder if I sold too early. But I was kind of happy I did, because it had gone from 68 to 190. At that point in time, the put was only worth 17 cents. So I had paid for this trade. I was profitable in the first half hour of trading on this strangle position. And then I thought, well, okay, I guess that's maybe all I'm going to get. Maybe, I'll let this one go, let this put go till the end of the week. And really, if it goes to zero, I'm okay with that because I bought this thing for $1.38. And, I'm out of one side for $1.90, so I'm profitable. And then I went away and I was doing something else, and I came back around noontime, around 12:30, and I looked at this thing. I said, "Oh, isn't this interesting?" And then all of a sudden it came down here, and I said, "Wow, that is a measured move to the downside. That is a measured move to the downside." I wonder what happened. Well, apparently Bernanke, when he was in front of Congress, investors didn't like what he was saying. Basically, he was saying, we're not going to do anything. We're gonna go status quo. We're going to continue what we're doing. We're going to continue buying treasuries and blah blah blah. But and slowly we're going to start pulling out from that strategy. And then so it started dropping like a rock. And I was sticking around because I wanted to hear CNBC, the talking heads at 2 o'clock came on, and the the minutes had just been released, and the talking heads already had burger dots as to what it said. It was like, wait a second. And basically what they were doing is they were putting a little bit more meat on the bones of what came out from the May 1 meeting. And, basically it just kept dropping and dropping and dropping and dropping. And so I put on a Fibonacci from here to here to the lower high here, and there it was at 261.8. And this was right around 215. Well, I was busy, and I could see that it was dropping. And let me just put this on for a second. Let me come back up here and put on the 161 and show you how it flew past there. Okay, it flew past here. This was I was watching it there, and it flew past there. And I said, okay, I got to do something. I'm busy. But I'm going to put in a stop if it gets to the 261, and I'm going to put it in at the underlying price of 67.93. And I came back around 3:30 to look at how the market's going to close, and ding, there it is. I sold the put. So in one day it went to the 161 on the upside. Came down to the 261 on the put side, made 180% in a day. Pretty cool. Now, I had some people email me and say they waited till about 10 o'clock and they got a strangle, and they let the strangle go towards the end of the day, and they made out very well. Very well. So there's a couple ways that this strategy is not rocket science. You don't have to be pinpoint precision. The fibs kind of pinpoint your exit. They really do. How did I know here to let it go to the 261? Because it blew through the 161.8. That's how I knew to let it go. Okay. Did I want to get out before the end of the day? Yeah, I was hoping I would. What's interesting is let's look at what happened, overnight and then this morning. And now look at this. Okay. So you know, and we're pulling back a little bit, and that's just the way the market goes. But I thought that was a very interesting day, and you could have profited by this move if you would have had a strangle. You would have profited by this move if you would have seen this and seen this measured move right here and bought a put and a put only. You could have profited by this if you would have put a strangle on right here. There are many ways you could have profited by that. And the exit was pretty straightforward. So, you know, this was a pretty cool little thing. I had somebody send me an email, and unfortunately I don't have that right in front of me. And they said, you know, they got in with the straddle right here, and they just basically did exactly what I did. And he had a little bit different spread on it, and his reaction was, "Wow, you know, I made enough in one day." And isn't it great when it works like this? And I was like, yeah. Now what you got to do is keep doing this so that it works like this all the time. This happens all the time. All the time. Okay, that's FAS. Let's go ahead and take a peek at VXX. Oh, I eliminated VXX from my list, by the way, because this, you know, once I got out of this trade with 9%, I said, you know, VXX is just, it's too choppy. Oh, not VZZ, VXX. There you go. You probably recognize that a little better. So let me bring up VXX. This was going back to Monday. I set up a strangle here, got out right here, and what was interesting is that was also that 161.8. This was on Tuesday. That was right here. Okay, so you can see some support right there. And then I didn't get out at the bottom here, but then the next day it made a measured move, and I got out right down here. And this was I think this was a 161.8 measured move. Let's take a peek at it. Came down from the top here. I think I took that from to there and back up. Yeah, there you go, 161.8. Bingo. Are these things unbelievable? Unbelievable. And then I look at this thing and say, okay, I'm not going to do VXX anymore. Bye-bye. And look what I missed. But before you could have reacted to that, it took it all away. So, okay. No more VXX. No more VXX. Okay, GDX. GDX has got a little squeeze going on right now, and you know, I got into GDX right here, and so I got the Thursday. And I had to go to the 29 and the 27 because nobody had some of the early ones. Let me go up to the trade tab and show you this. I went out to the next week. Why not? And well, I see that people are in there right now. But let's see. Oh, okay, here it was. I wanted to get into the 27.5, and there was nobody there. Okay, remember that this just starts out on Thursday, so the open interest is building up, and nobody was there. And I don't want to go in and be the only one, because you know, one, I'm not going to have somebody else that's willing to sell that to me because there's nobody there. So I want to get in. So I went ahead and got the 29 and the 27. 29 and the 27. Okay, and they're about right where they're about right where they were when I got in there. Okay. Let me say one other thing before I open it up for questions. I also presented been busy little boy here. Also, I put together an example of a strangle versus a straddle. Remember, a straddle is when you buy and sell the put and the call right at the money at the same price. A strangle is where you go out a couple strike prices on the both the call and the put. Okay, and you know, when we see a squeeze like this, we're looking for a decent pop, a decent move. So my contention it is on a straddle, you're paying too much for it, and the one side, if it starts moving like the call did right here, if it starts moving, here's your anchor. You paid so much for this, even though you had a nice move here on the call, your anchor is this one because you paid too much for this. So let's see, this was buying right back here, putting on a straddle and a strangle, and then getting out right over here. Okay, so the straddle would have made me 13%. Pretty nice. The strangle would have made me 35% because I didn't have the big anchor weighing me down. That's why I like to do strangles versus straddles. Okay, a lot of people do straddles all the time because, you know, they'd rather pay more and you know, you don't have, you know, there's like everything else here in the market, you got pros and cons. The pro of a straddle is it's always going to have some value. In other words, if it goes up to 70, this is going to have value where this one doesn't. But with the strangle, let's say it goes to 68. This will have value, and this will have a little bit of value. But if it goes to 68, I'm in no man's land here on a strangle. So I'm dealing with time value and time value only. These guys have a little bit of intrinsic value. Remember, an option is made up of intrinsic value and time value. Well, out of the monies only have time value, so you can get caught in no man's land. So the pro is you can make more money because you don't have the anchor. And the con is you can get caught in no man's land. So it's, you know, once again, there's pros and cons to both of them. I like the strangle because the strategy is that when the Bollinger Bands constrict, we're looking for a pop. And most times we're going to get a pop that's bigger than the spread I've got on my strike prices, and that's going to be more profitable. Okay. All righty. Let me stop right now and open it up for questions before I go in to talk about the positions or position trades. Any questions on what I've got going on at all? Michael, I see you have your hand up.
Hear me?
Yeah, I can hear you now, Michael. Welcome.
Okay. My question, the GDX that you just showed, can you put Fibonacci's on that chart at this time to get some idea of what liable to happen?
Well, let's get rid of this for a second here. The problem is, Michael, at this point in time, you know, we had a squeeze. We had a pretty heavy duty squeeze here. So it pretty much is not doing anything. Now, the move at this point is up. However, it had this move up here, and now it pulled back, and now it's kind of in limbo. Let's see. That after saying that, let me see what we can do here. See, because this is if it, let's say I take it from here to here and back down, you know, it hit this area right here, and now it's in some kind of a pullback. So the question is right now, is this in a pullback, or am I heading south again? So, you know, I can look at that and say that I've got a measured move to the downside. So I don't know if that's a retracement, or whether or not it's actually a move to the downside. So I'd like to give this a little bit more time, Michael. A little bit more time.
Okay, so you just kind of watch it and figure out and just put it on when you can.
Yeah. Now, one of the things that's nice about this is that we put it on today, and it doesn't expire until next Friday. So now if I only had 1 day left on here, what I would do is definitely come up here and put a, I'd say, let's look at this measured move here. If I had 1 day left, this is the Fibonacci that I would be using to judge whether or not I should have gotten out. I probably would have gotten out right here, but I don't. I've got a whole week, so I'm not. You know, it's kind of sitting in this little channel here, so I'm kind of letting it go at this point in time to give it a little bit more time before I go ahead and jump and say I got to get out of here.
Okay, thank you.
Okay, Michael, you bet. Good question. All righty. Frederick, I see you have your hand up. Let me unmute you. Frederick, question. Uh-oh. Frederick cannot hear you. Bummer. Let's see. Fred, I see you have your hand up. Let me, was that an earlier question, Fred, or do you have another question?
No, this was some time ago, but I do have a question. I did
Excellent.
not hear what John said. I think he asked you to do one for a bear call.
Yes, yeah, that was Jim Fay.
I'm sorry, Jim. Okay,
Yeah.
well, thank you very much.
Yes.
That'll be great.
Yes, and I'm going to do that, but I'm going to do a little bit different area so I can show you the same thing. But I will get to that, Fred.
Thank you.
You bet. Okay, let's see. Jim, I see you have your hand up again. Let me see. Another question?
Yes, Dale. I believe you're going to send a PDF of that Stranglebuster straddle out.
Yes, I will send PDFs of both those out to you. Absolutely. Thanks for reminding me of that. Yep, will do. Okay, excellent. Alrighty, let's go ahead and look at some of our positions, and we don't have very many. We got PEP, and or we didn't get PEP. Now, we didn't get PEP because it had a move up here and never came down. So you know, at this point in time, do we grab PEP? I'd be okay with that. And as a matter of fact, that's interesting because today's move took it down below here, so we've got a lower low. It actually pushed below the 35-day moving average. I'm going to wait till this closes and see what happens. If it stays like that, yeah, I'll probably put on a put. Let's take a peek at which one we're going to do. Okay, this is the one where we had to go way out to October. 81 at $8, about a 90, and I'm okay. Yeah, there's a big difference between the bid and the ask here. I don't like that. I don't like that. So let me come back down here and probably think about this one. It's good, good open interest, good bid ask, and that's the one I'd probably be thinking of. I've got it down here to take a look at that after the market closes and see if I still confer with that. Okay, VZ did a fake out on us. We got in first thing in the morning. Now it's risen, but I'm okay. I'm okay with VZ because it went and made a measured move right here. So I'm okay with getting into VZ. I like it. I like it. Let's take a look at KO, Coca-Cola. Coca-Cola is the same thing, but it's got a little bit more to go before it makes that. That actually wouldn't be a measured move because that was still moving up. So, but it's right around that 35-day moving average. I'm okay with Coca-Cola and Verizon, and I'll be revisiting PepsiCo after the close today to see if we want to get in that. Let's see if silver is telling us anything. Nope. Nope. Not ready to jump on the silver bandwagon. How about Stryker? Well, Stryker sure does look pretty nice, doesn't it? Let's see here. There was ready, set. Waiting just a little bit on Stryker. Waiting just a little bit on Stryker. Baxter I'm not going to do anything with. Not going to do anything with Baxter. Yeah, and we've talked a lot about Baxter, and you know they say that you should always be watching the market because 80% of the stocks go according to the market. Well, that means there's a boatload of stocks that don't go according to the market, and we've got a couple here. But I think Baxter's one of those that just is it mirrors the market. So you know, and we looked at the market and said, hey, we got a little bit of recovery today, so it's probably going to continue to be strong. So I'm not going to get into Baxter. Let's take a look at DTV. DTV is another one I was thinking of. Not quite yet. Not quite yet. Okay. So, you know, be listening to the blog tonight, talking a little bit about PepsiCo. Any final questions? Any final questions? Harry, I see you just put your hand up. Let me unmute you. Harry, haven't talked to you in a while. How you doing?
Well, I'm doing just fine, and I thought maybe I'd brag a little bit. I was escaped. I was lucky on the FAS. I put a strangle in about 8:02 yesterday. That's my time. That's mountain time.
Okay, so that's about 10 o'clock. Okay.
That is correct.
Yep.
And I got a 81 put and a 82 call, and I let it go. And I was busy yesterday. I couldn't get to the computer as much as I wanted to, and I missed that raise where it went up. And I came back and I looked at it and I, wow, what do I want to do here? And I said, well, I'm just going to let it run for a little, see what happens. And then I got called away about 2 hours before the market closed, and I didn't get back until 2 hours after the market closed.
Okay.
And so I carried that through the night.
Okay.
Talk about accidental.
And I put on the fibs on the tops up there like you did when I came down to a 423 line down below.
Okay, let me put
And,
that one on.
yeah.
Okay.
And the market came right down to that area,
Yep.
and I put a stop in it there, and it took me right out. So that's where I got out. So I made pretty good money yesterday. I'm happy as a lark.
Isn't this fun?
Oh, it's wonderful. That was completely accidental because I couldn't get near the computer yesterday.
Well,
Otherwise, I'd have been out sooner than that.
well, you know something, Harry. If you would have gotten out like right around here, you would have made a boatload of money too. You just were fortunate that overnight and this morning it continued on, because now we're into a little bit of recovery here. But you had it set up properly, and this last little bit was a bonus. So congratulations.
Yeah, that is a bonus.
Yeah,
I appreciate it.
You're welcome, Harry. That was excellent. I love to hear that stuff. That's fantastic. Fantastic. James Bell, I see you have your hand up again. I don't know if you got another question. I'm going to unmute you here for a second, and I'm not going to say anything because you got some feedback. I'll just let you ask the question.
Unmuted.
No, I don't have a question. My thing says my hand is down.
Okay. It's one of those that it's just like a bull put. It's just the opposite of what you would think. John, I see you have your hand up. Let me unmute you. John, did you have a question?
Yes. I don't know whether I asked this or not, but why are you going out to October for Pepsi?
Yeah, I think you did ask that before. And what I said was, 57 days is only 2 months out, and I'd rather see a little bit more time than that. I doubt that we're going to be in there for the full amount here, but the difference between let's take a look at the 82.5 is $4. Okay, in July the 82.5 is 2.5. So it's not that much more for the October. Gives me a little. This is too short, John. I'd rather go at least 100 days.
So you're advocating 82.5 instead of 85, then? Is that what you're saying?
Yeah, and the other no, I'm sorry. The 85 would be better. Absolutely, the 85 would be better. Yeah, it gives us a better delta, and it has plenty of open interest. I just don't think we should go all the way out to the 90 because it has 30 cents difference between the bid and the ask, where this is a dime.
And not much interest either.
No, not at all.
Yeah.
Yep.
Yeah. Okay.
Okay.
I understand your position.
All right.
Thank
Good.
you.
You bet, John. You bet. Bob, I see you have your hand up for the final question. Bob, how you doing today?
I'm doing fine, Dale.
Excellent.
I'm just trying to test my hand up thing, because every time the arrow is green, I think my hand's up, and the arrow, now I put it down, so you saw it up. So I guess it is like the puts it, so I have to remember that.
Okay, good. So no question, Bob?
Well, I don't have a question as such, but I just wanted to give a heads up on something I like to do and maybe see what you think of it. But right now, I like the financial stocks, the credit card stocks. If you take a look at like Visa, over the last, well, pretty much 6 months, I mean, they're just hitting up. I mean, they just follow that trend line, and they're hitting new highs almost constantly.
Yeah.
And I think with all the banks right now, when you can borrow money from the government at 1 or 2% and put it out and collect 14, credit card companies collect 14 to 20,
Yes.
something like that.
Yes.
That's just a solid, nice run for an option. You know,
Yeah.
I thought it's hard to find call options that aren't up against the line, you know, the retracement lines, and you know, something like the credit card companies. I've been on these for a couple months, and they've just been nice, steady movers, at least in this environment right now. I thought maybe some of your mentees might like that. So
Interesting. That's
just,
that's very interesting, Bob. What is MasterCard? Is that MC?
I believe, yeah. I'm not on MasterCard. I just got into Discover. They were sort of late to the party, so to speak.
Okay.
And I've just got that one about, I guess it was a week ago.
Looks like it's not MC. What is Discover?
DFS. There, I think. Let me double check.
DFS. Yeah, that's what it is. DFS. Yeah, it's almost identical to Visa. That's a nice little look-see here, because it's falling right in the middle of the regression channel, sloping up. You know, here you're just strong on the Williams percent R, and the money flow just continues to go in there. You know, I hear what you're saying, and let me just go back to Visa for a while. It's interesting because I think it was either last year or 2 years ago, Visa was one of my financially strong stocks, and I dropped it because
last year.
Yeah, because they didn't have a very good year. Let's go out to the September, and see, it's pretty expensive. So I'd probably go with like a 160. That's I think the reason with Visa, it was too expensive.
I have a tendency to roll them over too, so
Okay.
I sort of go deep. I sort of go a little deeper in the money. That,
Okay.
You know, not real, but then I'll roll them over, and
Okay.
boy, you can compound the rollover and something like that pretty nicely. But
And the options on Discover are a little bit more realistic.
yeah,
I like this a lot.
Yeah.
Discover. I'm going to steal with pride here, Bob, and I am going to actually use that. You know, I like what you did here. I love what you did here. So let me go ahead and buy. I'll probably buy 43. I'll buy a couple of them. Midpoint. Cool. We'll keep an eye on that one. Hey, Bob, I love that. That's a real good add-on. Thank you.
okay, just a simple question for you. That
Yes.
little boat that was flashing on your desktop.
Mm-hmm.
Did you buy that with your winnings yesterday?
No, that was actually looking out of our condo in Aruba, and those boats sail by. I mean, the water's just beautiful, and their sailboats are going by all day long. And I love that picture because it puts my mind at ease.
Yeah, I'm sure it does. I
but-
won't give you my sob story, but my computer was down yesterday, and I couldn't put on the spread for the
Okay.
deal, and I couldn't get out of my when FAS was up to 360. I couldn't do anything, so I'm just riding it out. I'll probably have a rough week this week.
Okay.
But
Okay.
I'll get it back next week.
Yeah, absolutely. Good deal. Okay, that's it for today. And, you know, remember, if you want to come and listen to more of me tonight at 4:30 Eastern Time, I'll be a Trade Monster. And other than that, I hope everybody has a great weekend, and we will talk to you next Tuesday. Bye-bye now.